Okay, so for this one, we're going to pick up where we left off, which is we're going to resolve the mystery of which of the two numbers we want to emphasize for record keeping, either that 500,000 what we paid, or the $2 million, which is what the current fair market value, FMV, is, according to, again, one or more people's opinion. And the answer here is which one we want to stick with, and that would be we want to go with the historical cost here. In other words, the 500,000 is one we want to emphasize, because why? Because it's verifiable. That's the thing. It's verifiable. That fair market value, the problem with that is that it's, again, somebody's opinion. It's not verifiable, and it might fluctuate from time to time. So instead of going through the rigors of having to constantly reevaluate that, we just say, just book it at what we verifiably know was the cost of that land in this instance. Now, there are some exceptions to this, abhorrence for fair market value, but they're going to be, pretty much intermediate or advanced financial accounting textbooks, not really useful in the context of an introductory class. So you'll see it some other time. And so the next big topic here is going to be business transactions, and this promises to probably be one of the shorter videos, or maybe not, we'll see. And so again, the definition of a business transaction is basically two parts. First, it has to be an event that poses an economic impact on the corporation, and it must be measurable, in this case in US dollars. So if you check those two boxes, you have on your hands a legitimate business transaction. So again, now you understand why we ignore that ask price, the offer, and the appraisal of $2 million, because why? There was no relevant exchange being involved here. They wanted 600, we paid 500. Somebody said, I'll give you $1 million for it. We said, no, thanks. Somebody said it's worth $2 million, and that's all there's to it. Now, if I change the narrative to they sold it for $2 million, now we have a business transaction on our hands. So that's the difference there. And so these business transactions that you'll see in this class fall into two generic, and these are now official categories. I only bring that up because I've been teaching this long before it was included in any textbook. Not claiming authorship, just claiming that the insight came to me over the years. Probably it's been almost a couple of decades now. I said, you can just look at them as being either external or internal in nature, which just really means what's the instigating factor? What's making you account for this transaction? Is it external, meaning it's interaction with your company and some other entity, or that can include just about anything? This is not an exhaustive list. Other corporations, partnerships, proprietorships, private individuals in the government. So any entity you could conceivably do some sort of business with would be included in that. Now, in the case of internal, it means that we have an economic event in need of recognition, but again, it's independently going to be determined by whom? By the company in this case. In this case, C is my shorthand for the company in question here. So those are your two realms, like transactions that are interactions with other entities, or just strictly within your own confines deciding we need to account for something. All right, so let's look at an example of an external here that I've drawn up. All right, so we have C is going to deliver goods on behalf of P, charges $2,500. P is going to tender $2,500 cash to C for this service. The transfer of the $2,500 from P to C fulfills both aspects of the business transaction. We have economic impact, clearly, because we receive money, and we also have measurability because we measured it as $2,500. Now, what if instead of actually receiving cash, they only received a promise? So in other words, P, whoever this other entity is, promises to pay the $2,500. We would still consider that a business transaction because, again, in financial accounting, our standards say that it's okay to book promises more or less on par with actual payment. We'll talk more later about exactly how that works, and that'll be in the next video in this series that you'll see exactly what I'm talking about when I say what constitutes a promise and how do we label it. You'll see that in the next one. And just a little digression here. All you're going to see in this first stretch in the class is businesses that are service businesses. In this case, we had somebody delivering goods. Right? So any business that's just a service business. Why? Because as soon as you move to the realm of selling tangible goods, which is inventory, it gets a lot more difficult. So again, that's why we put that off until the 5th chapter because of that, because of the difficulties associated with moving into the realm of tangible goods. right, so what about internal? So again, we have this independent internal determination that we have to book something. Now, as I suggest, it could relate to a previous external transaction, but it's not necessarily the case. I also want you to put sort of a bookmark in your brain and come back to, like, there is a more proper term or terms for internal transactions, but I will not bring them up here. I'll bring them up in a later video. So somewhere in a future video, I'm going to, when we're talking about some other subject, I'll say, remember back when I told you about that bookmark? And that's where you should go, oh yeah, right, the bookmark. And then we'll fill in the blank of exactly what we mean by internal transactions or internally generated. All right, so here, the example I give is we have C purchased a car from Hopkins Motors in January. That's clearly external, right? So purchasing a car from some car dealer, external. But what's going to happen is we get to the end of the year, and now C is going to be compelled to devalue the vehicle in accordance with generally accepted accounting principles, because what we have on our hands here is something that we own that is obviously being used up, right? Because we're using it in the business. So as a consequence of that, we need to devalue it. In this case, they come up with the calculation says we got to write it down $10,500. Now, the proper term for this devaluation is called depreciation, which will be fleshed out in later chapters. Again, and actually, it'll be not until we get to the concept of adjusting entries, we'll tell you how to actually book that type of transaction. And then it won't be until the 9th chapter before we actually say, oh, and this is how you would actually calculate it. So it's going to be left somewhat mysterious, not entirely, for a while. All right, that concludes this video. Again, the next one's going to pick up with the main topic of interest of this first chapter here, which is the accounting equation. So see you in that one.